Good morning and welcome to today's meeting. We have two subset discussions today. The first starting on 4 topics related to consolidation with potential agenda decisions by our board. And the second will deal with environmental obligations and asset retirement obligations. So we'll tee up our consolidations team first this morning. Good morning. And good morning, Sam.
Thanks, Rich, and good morning, everybody. Topic 810, consolidation, provides guidance for determining whether a reporting entity has a controlling financial interest in another entity and, therefore, is required to consolidate that entity. An entity with a variable interest in another entity often has to consider detailed guidance to determine which of the two primary consolidation models, the voting interest entity model or the variable interest entity model, also known as VAE model, should be applied. At a high level, for voting interest entity, control can be conveyed through a majority voting interest. By contrast, a VAE may be controlled through variable interests other than a majority voting interest, such as through a contractual arrangement. However, the criteria used to determine if an entity is VAE or a voting interest entity are detailed and can be complex. For example, those criteria require that a reporting entity consider whether the entity it's analyzing for consolidation has sufficient equity investment at risk, whether equity holders collectively have the characteristics of a controlling financial interest, and certain scenarios in which the equity investors' voting rights are not proportional to the economics. Often, these criteria need to be considered to conclude that an entity is a voting interest entity and not a VIE, even if it's clear that the entity is controlled through voting interests. For entities that apply the voting interest entity model, the usual condition for controlling financial interest is ownership of a majority voting interest. By contrast, a controlling financial interest under the VIE model generally requires both 1, the power to direct the activities that most significantly impact the VAE's economic performance, and 2, the obligation to absorb significant losses or the right to receive significant benefits from the VIE. Beyond that high-level difference, there are a myriad of differences between these two models, including how participating or veto rights are considered and how related parties are considered in the analysis. For example, under the VIE model, an entity could be required to consolidate a VIE even though it does not have the power or significant economics on a standalone basis due to the rights held by related parties. In contrast to US GAAP, IFRS 10, Consolidated Financial Statements, provides for a consolidation model that does not distinguish between VIEs and voting interest entities in the same manner. Stakeholders often refer to the guidance in IFRS 10 as a single consolidation model. I'll now turn it over to Chris, who will provide a summary of the agenda consultation feedback and the staff's recommendations and analysis.
Thanks, Sam. To consider whether a single consolidation model could be developed in US GAAP, the current research project, Consolidation for Business Entities, was added to the research agenda in April 2022. In the most recent invitation to comment on agenda consultation, stakeholders were asked if the board should prioritize a project to develop a single consolidation model and whether it should leverage the guidance in IFRS, the VIE model, or the voting interest entity model as a starting point. The ITC also asked whether targeted improvements should be pursued to better align the separate models and whether there are pervasive accounting outcomes that are inconsistent with the underlying economics of the transaction. Almost 30 stakeholders directly responded to these questions or provided general feedback on consolidation. Overall, those stakeholders provided mixed feedback on whether the board should prioritize a project to develop a single consolidation model. Some stakeholders, primarily practitioners, noted that it should be a top priority, while some others identified it as a low priority. The feedback indicated that many stakeholders experienced challenges in determining whether an entity is a VIE or a voting interest entity. Some stakeholders also highlighted challenges associated with the related party guidance in the VIE model, including that it can be difficult to apply and can result in forced consolidation outcomes that Sam described in his tee-up. Similarly, some stakeholders highlighted challenges applying the guidance in Topic 810 as it pertains to determining whether a decision maker is acting as a principal or is acting as an agent. Most stakeholders that expressed support for changes to the consolidation guidance indicated that the board should develop a single consolidation model based on the VIE model or IFRS 10 to address existing challenges. Stakeholders that noted that a single consolidation model They noted that it would eliminate the need to identify whether an entity is a VIE or a voting interest entity, and it would resolve inconsistencies, including inconsistent outcomes between the VIE and voting interest entity models. Some also noted that it could resolve areas that are inconsistent between the two models, such as each model having a different definition of the term participating rights. However, many stakeholders did not support a single consolidation model. Those stakeholders noted that the current guidance is operational and well understood. There's no pervasive issue to justify a project with such a broad scope, and introducing a single model could result in implementation complexity or unintended consequences. There was also mixed feedback on whether to pursue targeted improvements. Some stakeholders were skeptical that targeted improvements would succeed in simplifying the guidance. On outcomes, many stakeholders that provided feedback on the consolidation guidance did not indicate that there are pervasive accounting outcomes that are inconsistent with the underlying economics. Even some stakeholders that supported a single consolidation model stated that it is important to ensure that any changes not affect consolidation results in certain structures, particularly those that tend to affect asset managers. For example, some noted that applying the current decision maker guidance when a general partner or a managing member is acting as a fiduciary appropriately reflects the relationship on a non-consolidated basis. However, some also noted that the inconsistencies in the VIE and voting interest entity models can result in outcomes that are not consistent, even for entities that are controlled through voting interests. There are also differences in the disclosure requirements between VIEs and voting interest entities, with there being many specific disclosure requirements applicable to VIEs that do not apply to voting interest entities. Some stakeholders indicated that the VIE disclosure should be eliminated, rationalized, or harmonized between the VIE and voting interest entity models. Other areas of feedback on the broad topic of consolidation covered outcomes for certain special purpose vehicles, the control by contract guidance for non-VIEs, and potential and future voting rights. In light of this feedback, we've analyzed several approaches for the board's consideration. Approach A would seek to streamline the VIE voting interest entity determination and eliminate unnecessary differences between the models. Further staff research could identify whether, for example, the sufficiency of equity at risk criterion, the disproportionality, or sometimes called the anti-abuse criterion, the inconsistent definitions of participating rights, and the guidance on related parties could be improved. By contrast, approaches B and C would take less targeted approaches and would instead pursue a single consolidation model based on the VIE model and IFRS 10, respectively. As part of any of those approaches, we would also consider reevaluating the existing disclosure requirements. Furthermore, and in line with a suggestion from a comment letter respondent, we also think it would be important to explore whether a prospective transition approach could alleviate some of the concerns related to implementation costs associated with the new guidance. For this meeting, we recognize that any of these changes could significantly impact many companies. Therefore, we think more research is needed to establish whether there are technically feasible solutions for which the expected benefits justify the cost of change. If the board chooses to pursue further research, we recommend approach A. We think that approach A has the potential to address current practice issues while minimizing the risks of unintended consequences. By contrast, the other approaches, such as approach B and approach C, could significantly change the conclusions for certain types of companies, such as asset managers, in a way that is not justified by the feedback we received during the agenda consultation. Similarly, we also do not recommend holistically reconsidering the principal agent guidance in Topic 810. If the board is intent on pursuing a single consolidation model, then we would recommend starting with approach B based on the VIE model rather than approach C based on IFRS 10. We think that in the context of U.S. companies, the effects on outcomes under approach B would be easier to anticipate than under approach C. With that, I'll turn it over to the board to discuss questions 1 through 4.
Okay, any general questions on the robust materials that staff has provided us on in advance of this meeting? Okay, Sue, may I start with you?
Sure. So I want to commend the staff on the memos. I thought they were really well done. I thought that I appreciated the historical context, the depth of the research, as well as reminding us about all of the previous standard setting activities. Consolidations, I think, is a really tricky topic. It's one of those areas where the guidance is really dense. And it was issued at a time when, there were a number of accounting anomalies in the system. related to off-balance sheet activities. And my experience is that preparers really struggle with this in interpreting the guidance. And they're relying very heavily on their auditors and particularly national office specialists to help them navigate the guidance. It's not particularly easy to navigate, as well as the way it's written. It's not necessarily what I would call plain English either. And so I think that at this juncture, I think we've heard, as you point out, that many have said that the outcomes are economic. In other words, the answers that the model is providing is economic. It is what it should be, but the journey to get there is really difficult. And my sense from the feedback that we've gotten, not just from the efforts in the ITC, but just over the years, is that there's likely a lot of diversity in practice in the way some of the words are interpreted in some of the guidance. And I thought that the respondents to the ITC had a lot of great suggestions. So I think it'll help us to frame a project as we go forward. As it relates to the paths that you put in front of us, it's probably not a surprise that I prefer approach A. I think, because it reflects more targeted improvements, it will help us align the economics and it will close certain structuring opportunities. And in my experience, I think one of the most challenging aspects of the model is determining whether I have a VI and a VIE. The actual power and benefits is actually much easier than some of the initial determinations that you need to make when you're actually applying the VIE model. And I think entities really struggle with applying the related party tiebreaker guidance, even though we've made tweaks to it over the years. I think it's still a bit of a struggle. So I would support an approach A that you've outlined in the memo. At this point, I wouldn't support pursuing a single model. I think since the outcomes are largely okay, I don't think that there's a case for change in having upending the consolidation guidance and sort of forcing folks to sort of relearn the guidance. There's always a cost to change. And I think we learned that a little bit when we were doing the software project. Not that it's anything related to this, but when we were thinking about a single model there. And it does seem like investors are getting the information they need. I think we've spent a lot of time over the last decade trying to pursue a single model without real success. So I just don't see that as a priority at this point in time. So I would support approach A. On your other questions, question 3, I think that was the item E, issues in the memo. I would be open to providing further clarification on implementation guidance around potential or future voting rights. I think that's another area where maybe some implementation guidance would actually be helpful, just to kind of strike some consistency in practice in the way folks are interpreting that at the initial assessment or when something's triggered, say, for example. On question 4, I would also look at disclosures. I think, the disclosures on the VIE model are very comprehensive. Even when an entity doesn't actually make the determination they need to consolidate. And so I think like a post-implementation type review of the disclosures to understand which ones are actually being used by investors and how they're using them would be useful to see if there was either opportunities to streamline or, make some additions or improvements for things perhaps that they're not getting. And so I think that's your questions 1, 2, 3, and 4.
Thanks, sir. Joyce?
Thanks, Rich, and good morning. I'd like to thank the staff for a very detailed board memo that includes research and analysis that I thought was so comprehensive and informative. Thank you for that. It certainly has enabled me to be better prepared for this discussion today. In terms of your questions, I'll start with question 2. The respondents who provided comments, in my view, have raised specific issues that potentially could be isolated and researched in a targeted manner as suggested in Approach A. I think that there were valid arguments that were made regarding operability and complexity concerns, and they largely exist due to the layers of consolidation models and guidance that have been established over time. I think the staff should perform research to address those challenges in the VIE, VOE determination without necessarily creating a new single model as suggested under approaches B and C that potentially would cause costly changes to the preparer's consolidation analysis, to their systems, to their processes, to their controls, when today investors are not raising concerns regarding the current accounting impeding their decision-making capabilities. Furthermore, there is not widespread feedback that current accounting outcomes do not materially depict the economics of the arrangements. So I think addressing targeted issues, most notably those raised by the respondents as being more prevalent, that make determining the VIE or the VOE is a plausible approach. As you've mentioned, Chris, for example, we heard that the application of quantitative thresholds in the determination of the sufficiency in which equity is at risk, whereby bright line percentages may not address the substance of the arrangements. And in some cases, the interpretation has resulted in diversity in the application. And there are other examples which you've mentioned, Chris, as for example, the participating rights issue, which could also be addressed under Approach A. I think that we should be mindful of the prior work that has been done in this space so that we don't sort of fall down a path that where we cannot find a solution. I think it's important to recognize the attempts to address that matter in the past. Another example is related party considerations and applications, notably the related party tiebreaker rule, which respondents have stated that sometimes it causes one to consolidate an entity but overlook the substance of the arrangements in certain circumstances. So I support additional research following Approach A with the intent of addressing targeted areas to potentially reduce or eliminate unclear, complex aspects and unwarranted differences between the two models. Regarding question 3, enhancing disclosures and addressing outdated disclosures were amongst the top areas of priority for respondents to the agenda consultation broadly. There are layers of consolidation guidance that have been built over time, as Sue has also mentioned. It has been my experience within the credit analytical space that a comprehensive analysis of an entity's overall ability to meet its financial obligations is performed taking into account the economic involvement with a VIE. As a result, there are times when analytical adjustments may be made to reported information leveraging the VIE disclosures. In these analyses, the nature of the variable interest is analyzed to determine whether or not it should be captured as a debt-like arrangement or an equity-like arrangement in the credit economic assessments. When considering liquidity, the effect of VIE operations, such as working capital outflows or cash receipts on the consolidated free operating cash flow of an issuer, is also assessed. And there are risk evaluations made to address the potential impact of VIEs on the issuer's creditworthiness to assess, for example, whether creditors of the VIE have recourse to the primary beneficiary. So I use these examples of the analytical process to emphasize the importance of obtaining broad investor feedback when addressing the relevance of the disclosures and any potential suggestions of eliminating information that is currently available for analytical purposes today. Clearly recognizing that there are layers of disclosures that may be conflicting, they may be redundant. Certainly that assessment in terms of having more effective and relevant disclosures is appropriate and I think necessary. However, taking into consideration the array of analysts and investors who are relying on that information. And I have no further comments on question 4.
Okay, great, Joyce. Marcia.
I want to thank the staff for all the material. As it relates to consolidations, this week has caused me to just accept the reality that in the winter it snows, sometimes a lot, and getting through the consolidation guidance and our codification is not easy. I think those are just facts. At the end of the day, the snow melts. And at the end of the day, it seems that we get conclusions about consolidation that are meaningful. Those also seem to be facts. So I did not find, I appreciate, but did not find the comments that would support a single model or starting over with the IFRS model to be persuasive because, like I said, the snow eventually melts and we eventually get an outcome that makes some sense. And I don't think that it's reasonable to upend that. But I could support approach A, especially if there are targeted improvements that can be made that make applying the guidance easier for everyone involved. So in that respect, I agree with the staff recommendation. As it relates to additional thoughts, I liked the way Sue phrased an objective of reviewing the disclosures. I think I would share that objective, that I think that as part of this, if we're going to do some more research, it would be useful to go through the disclosures that are available, understand who uses them and how. And if there are disclosures that are really not being used, then maybe we should streamline them. If there are disclosures that are missing, it would be interesting to understand that as well. So I'm open and would find it of interest to hear a little bit more about what our stakeholders have to say about disclosures. I think that's my summary comments. And eventually the snow will melt.
We hope. All right, Fred, you're up.
As a Californian, I certainly hope that does play itself out. Well, thanks, and thanks to the staff also. I think I'll take a little bit different approach here because I think, this project came to us really as practitioner-driven because of the difficulties and the hurdles here. And we heard that we didn't really want to change outcomes because they're okay, I think is used. I think that's important to step back, though, and recognize that I think that in my view, looking at this, many preparers and investors don't necessarily love the outcomes. They're just very hesitant to any further changes. In particular, I was reviewing analysts' analysis of alternative asset managers, and there is a significant amount of non-GAAP reporting and adjustments to GAAP to get it more meaningful economics. Because I think, as the staff pointed out, we really have a control model, not a model driven purely on economics. I think that's important to recognize. So I think as we think about this project, especially, I think it's important to step back and say, okay, it's not as if investors and preparers love the answers, and it's not as if they're not having to undo, especially in the alternative manager space, undo current GAAP to get more meaningful line items to forecast. It's really that they've found a way to adapt the current model so that they get the information they need. And number two is that they're very hesitant for us to take on a broad project for fear of greater consolidation that would have to get undone by by analysts. So I think that's kind of where we are today. So I think one of the pieces of further research as we look at this is really to look at get in touch with analysts and preparers, especially in the alternative manager space, to understand what's being done today in terms of the analysis of that. And if there is consolidation that's being undone today to get, to understand the economics better. So I think that's important as we embark on this project, to ensure that we do that. And also, I think it's important to ensure to preparers and investors that we're not trying to upend the model to have, greater consolidation that's going to create bigger problems for them. What we're trying to do is really targeted changes that can improve the model and maybe even get some better answers. Because as we know, anytime we change things, we do get some different answers. So in that sense, so given that background, I would support moving ahead on approach A, but given some real outreach with both preparers and investors in the alternative management space. In terms of disclosures, again, I think there's more research needs to be done here, which I think you're proposing, especially to understand what is being used today and what isn't being used today, to see if we can improve the disclosure. So that's question 3. And then I think I've already answered on 4 that I think a better understanding of what's being done in that alternative management space would be very helpful as we think about putting this project on our agenda. Thanks.
All right. Thanks, Fred. Christine?
Good morning. I also wanted to compliment the staff on the excellent memos that you all put together. It was quite the package, and it was helpful to see them all together to understand the relationships among all of the disparate pieces. So in terms of continuing research, I do support continuing the work on the targeted improvements. I think initially I was a little skeptical just because we didn't hear a lot from preparers and investors that this is a problem area. And I think that that may be because they rely a lot on their auditors, or it may be that they've figured out how to undo it when they don't like the answer. But that said, I do think that we got some good suggestions from the practitioner group that responded with regards to some changes that could be made to streamline things. So I would encourage the staff, I guess, to continue to research the targeted changes. I don't think there's a case for change for big changes that would change outcomes. On the disclosures, I think that more research on the disclosure package would be really helpful, in particular focusing on investors and their feedback on what they're currently receiving, not only under the VIE model, but also under the VOE model. It seems that the one piece of feedback that we did hear from one investor and one advisory group meeting, so this is very anecdotal, was that the disclosures that they receive under the VIE model are more useful than the disclosures that they receive under the VOE model. There may be reasons why the disclosures are different because the arrangements are different, but if there are disclosures that would be relevant to entities that are consolidated under the VOE model as well, I don't think there should be differences in the disclosure package just for differences' sake. So I would encourage understanding not only the VIE disclosures but also the VOE disclosures, and I think that so far we haven't received a lot of feedback from investors on that. So I do think that that should be a focus of that research. And I think that's it. Thanks.
Okay, thanks, Christine. Hillary?
Appreciate all of the staff work on this and appreciate stakeholders for continuing to come along on the journey related to consolidations with us. And while I appreciate a lot of the feedback from our stakeholders that in a perfect world, a single consolidation model would be ideal, I don't necessarily believe that we have the case for change to get to a single consolidation model. And generally, folks are, understanding the outcomes that they're getting today from a consolidation perspective. And I think that a significant change with regards to that could be very disruptive from a practice perspective. However, I do think that there are significant improvements that could be made to the consolidation guidance. And I know for many of us who've had to apply this guidance for many different type of entities, it's complex, it's difficult to explain. You have the opportunity for structuring opportunities, depending on whether you're looking at, whether it's a VOE or a VIE and participating rights, kickout rights, related parties, right? All of these things come into play that I think make this model very complex, needing to be applied by specialists. And therefore, I don't think this is just a practitioner issue. I think this is a preparer issue. Having been someone who on the other side help preparers have to do their consolidation analysis, I think we've effectively made this model so complex that we're requiring specialists in national offices to get involved to help folks identify whether or not they have to consolidate or not. And certainly, I think that we can make some significant improvements with targeted improvements to this guidance. So I would be in favor of an approach A with regards to looking at the targeted improvements. I have no doubt that even though we're calling them targeted, that these are not necessarily easy improvements, right? So from my perspective, I think going at it with an idea of being able to bring together some of the differences between VIE and voting guidance, I think would be the goal of it. But maybe we may not be able to eliminate all of the differences. But I certainly think that we can make it easier for folks to identify whether they have those differences and whether that continues to make sense in the context of today's environment. I also have a significant interest in relooking at the VIE criteria and continuing to see whether those are fit for purpose today. Certainly, I think that guidance hasn't been looked at, even though the model for VIEs has changed over time. And I think sufficiency of equity should be relooked at. And I think that disproportionality should also be considered in the context of additional research with regards to related party guidance. Certainly, I think that from a disclosure perspective, it's another area I'd be interested in from the standpoint of really rationalizing the disclosures, right? I think a lot of the disclosures were put in place at a certain time when the guidance was put in place and it has an anti-abuse spin. I mean, there's no doubt that the VIE model was put in place from an anti-abuse lens, right? And I think it's absolutely fair to take a look at the disclosures to say, what are disclosures that are necessary for investors to understand consolidated and maybe unconsolidated entities, whether those are VIEs or voting interest entities. And I think that that would be an important part of this project to make sure that we have that alignment among the different models with regards to a disclosure perspective. So certainly, I think we have a really good chance here to be able to make some improvements to help make this guidance more understandable, to help maybe reduce some of the structuring opportunities that exist today. And I think that we can do that in a way that won't disrupt significantly outcomes that folks are generally comfortable with today. But I will say, when you change anything, there would be a potential for an outcome to change. I certainly would support prospective transition, being able to look at that. I know that's much further down the road, but that's certainly something I think is an important part of this discussion in talking about this with our stakeholders.
Great. So I'll echo my thanks to the staff for a robust set of materials that walked us down the history of consolidation and lots of the challenges that our stakeholders are facing. Just my own view, I actually think VIE consolidation's been used as a blunt tool when people didn't like the accounting for transactions between the entities. And I think we very often forced consolidation as a means of, because we didn't like the fact that, for example, leases were off balance sheet or that there were different funding commitments that weren't recognized. Probably wouldn't have been my preferred approach, but I recognize that that's where we are. The other thing that I noticed, though, is that people don't really complain about the VOE model. The real complaint is that they have to go through the voting interest model. The real complaint is that they have to go through the VIE model to get there to make sure they're in the right model. And to me, that indicates that really that's where our issue sits. So I guess I would lean toward approach A, focused solely on the VIE model. And I think a couple caveats that go along with that. One is to make sure that we don't change the voting model. I'm not hearing about complaints for that, so I really have no interest in changing that. If anything, I would just like to make it easier for those entities to realize they're in the right model and that they're not supposed to be in the VIE model. And I think that's through changes to the VIE model. Couple things. When we're looking at the VIE model, I kind of agree with some of the comments Fred made. I think the objective here, if anything, is less consolidation of VIEs, not more. And I really have no interest in forcing additional consolidation, particularly in asset management. I think we've taken that industry on a roller coaster ride over the years. And we seem to have ended in a place where, in general, most of them are happy and we're not hearing complaints. And so I'd be very careful in that area. So if the objective is to really minimize the complexity and the impact of the VIE model, possibly eliminating some attributes that create VIEs, I would be all for it. So interested in pursuing that direction. On the single model, starting with the VIE model, to me, that just seems like that would be creating more problems. So no interest in that one, but I don't hear it from my fellow board members. On the IFRS 10 model, well, I think we should always be interested in convergence when we can converge. My concern about that is if we were to take the IFRS 10 model and stick it into US GAAP, we would end up making lots of changes to it to deal with unique aspects of US GAAP, such as the investment company guide and other areas where we don't have consolidation. But we would also likely end up giving so much more guidance about its application to the structures that we have in the US that I'm not sure we would end up with the same answer as they get under IFRS. And I think that raises all kinds of issues, coupled with the fact that we're not hearing a lot of input saying, get me different consolidation answers. We're hearing input about, it's really hard to do this and we have too many footfalls and too much second guessing. And maybe there's too much consolidated. And so that's why I prefer the targeted approach. On disclosures, just a reaction. The VIE consolidated entity disclosures to me sound like you really don't like the consolidation answer. Because if you're looking for them because you're looking for more information about parent subsidiary funding relationships, I don't know why that would be restricted solely to VIEs. There's lots of issues with subsidiaries where the parent can't get to the assets or where they may have to fund commitments of the subsidiary, or there may be shifts between controlling and non-controlling interest holders. Those are not unique to VIEs. I think we've pointed those out. And so maybe somebody's using them, but I don't understand why that's different than for an entity that's consolidated via another model. Unless the answer is we're really not comfortable with consolidation because it masks some of those transactions between the entities. To me, the answer to that is maybe those entities shouldn't be consolidated. So I think that I would take a look at that. As far as the disclosures to non-consolidated VIEs, that just puts more pressure on the VIE VOE definition. And to me, if that's a transaction that needs a disclosure, I don't know why it matters whether it's a voting entity or a variable interest entity. To me, if you have a funding commitment, we should look at our funding commitment disclosure requirements. If you have variability in assets and the values that come to you, we should look at disclosures related to that. But I don't think it should be targeted to the type of entity in the consolidation model we're using. It should instead be focused on the transaction. So I would be interested in that. And I think the other thing that I would just add is what we've talked about here is a direction for research. So just to be clear to our audience, we haven't added it to our technical agenda. We've asked for follow-up on some of these issues for the staff to come back. But I do think we probably at that next meeting need to make a decision. Are we going to add this to our technical agenda or not? Really to be for clarity for our stakeholders. So maybe keep that as an objective, Chris and team, as you work on this for the next meeting. Okay. With that, we're going to move on to common control. And Chris, you're going to tee us up.
Thanks, Rich. Although the term common control appears throughout GAAP in the codification in various contexts, including the consolidation guidance in topic 810, it is not defined in the codification. Subtopic 80550 provides several examples of transactions that qualify as common control transactions, but in practice, the term is often interpreted to include transactions that are beyond those that are explicitly illustrated in the codification. Interpretations are instead often based on SEC staff guidance that was summarized in EITF issue 025. Under the criteria that were listed in EITF 025, which were not included in the FASB codification, common control exists between separate entities only in certain situations. Those situations include when an individual, an enterprise, a group of immediate family members, or a group of shareholders with contemporaneous written evidence to vote their shares in concert holds more than 50% of the voting ownership of each entity. The invitation to comment on agenda consultation asked whether the board should consider defining the term common control, and if so, how it should be defined and what the expected effect would be of doing so. Over 30 stakeholders responded to the ITC question on common control or provided general feedback on the definition of common control. This was one of the most frequently identified top priorities for practitioners as a group. However, other stakeholders noted that defining common control is a low priority. On the basis of the feedback received in both the agenda consultation comment letters and some of our outreach, the staff understands that most practitioners who support a codified definition of common control are supportive of establishing a definition using the past SEC staff speech that was summarized in EITF issue 025 as a starting point, but with updates to modernize the definition. Other stakeholders who identified defining common control as a top priority or said they would support such a project cited other reasons. Some noted that providing a definition of the term common control could address challenges in practice in determining whether commonly managed companies, such as those that are common in private equity structures, are under common control. Others noted that aligning the definitions of control across the codification should be prioritized because the use of multiple and inconsistent definitions of control creates inconsistency in the application of the consolidation, affiliate, and related party guidance. Others sought clarifications on the guidance for family relationships and transactions with a high degree of common ownership. So the staff considered the agenda decision criteria for this issue. We note that the lack of a codified definition of common control is an identifiable issue and believe that the recent feedback indicates that the lack of a definition creates a pervasive issue and gap. We also think there are feasible solutions for which the expected benefits would justify the expected cost of change. We think codifying a definition that is based on the SEC staff speech that was summarized in EITF issue 025 would be an appropriate starting point for business entities. While some suggested that the board more holistically reconsider the definition of control throughout GAP, the staff thinks that this would significantly impact practice, and we're unsure at this time if there would be broad stakeholder support for that type of a change. The staff thinks that the scope of a potential project is identifiable and would be focused on providing a definition in the master glossary that is based on current practice. Although this area was not a high priority for some stakeholders in the comment letters to the agenda consultation, the staff thinks it is more likely to be supported if it's completed expeditiously and with minimal disruption to current practice. Although several comment letter respondents provided feedback on scenarios in which there is common management but not common control, we do not recommend changes that would affect those outcomes. We also do not recommend addressing transactions with a high degree of common ownership within this potential project scope. Instead, we think efforts should instead focus on developing a clear definition and that is aligned with current practice to the extent possible. In summary, we recommend a project with the objective of clarifying existing gap by providing a definition of the term common control based on existing practice for areas of the codification that do not already have a clear existing definition. If the board adds a project on defining common control to its technical agenda, the staff plans to develop alternative definitions and conduct additional outreach. We expect this additional research will also cover entities applying a private company alternative to the VIE model for certain entities under common control and not-for-profit entities which themselves apply different consolidation guidance than applies to business entities. With that, I'll pass it back to the board to discuss questions 5 and 6.
Okay. Any questions for the staff? Okay, not seeing any. Marcia?
So thank you very much for this analysis. You know, this question of common control seems to come up a lot, and I'm thinking of many of our private company council meetings where there are issues with applying common control, defining common control, especially in that space. So I actually think it would be useful if we were to take this on, and I think that we would benefit a lot of stakeholders by doing that. I also appreciate that at this point, you're just talking about an objective and scope. You haven't given us a definition yet. So I understand we're adding this potentially to our technical agenda without some understanding of what could the ultimate conclusion be. But I agree with your objective, and I agree with your analysis, and I'm supportive of doing this. I think this would be helpful, and hopefully it might reduce some of the time and energy spent on these topics. I also agree with you about making sure we don't make changes where unintended consequences are to be avoided. And I know that there are certain areas where practice is well defined, well understood, and we don't really want to affect that. So I'm expecting that will inform your recommendation when you come back to us with definitions.
Okay, thanks, Marcia. Fred?
You know, I also support the staff recommendation in terms of a somewhat a project to do this. I view this more as a codification improvement than as a real change to the standards, because I think what we're trying to do is just make the codification easier to navigate so that people can understand which definition of common control to use when, rather than, upend the definition of common control. So that's the way I think the staff has framed it in my view, and I think I can support that as really a codification improvement project. I think it's going to be difficult. So I don't think we think codification improvement, that's straightforward. I don't think this is going to be straightforward at all. I think there's a lot of different definitions of it. So I think it's going to be a challenging project, but if the staff's willing to do it, I'll support you. Thanks.
Mm-hmm.
Thanks, Fred. Joyce?
Thanks, Jim. Rich, sorry. Okay, so I must say that I think this is going to be a huge challenge. I think your analysis is sound. I do agree that you've met the agenda criteria. When I look at the potential list of topics that this could potentially touch, I think that it can be pretty extensive and complex. But that being said, I think it is a worthy task. The reliance on non-authoritative guidance for such an important lever as the determination of common control is really indicative of an opportunity to provide guidance. Respondents have made it clear that there are varied and opposing applications resulting in diversity in practice. But again, that being said, there is the potential, given the vastness of this, of deriving a definition of common control that conflicts with existing guidance on common control transactions. And therefore, it is important to evaluate the nature and the extent to which any potential alternatives may cause conflicts with the existing guidance. And in addition to evaluating the potential cost of change to preparers and any potential impact to accounting outcomes.
Okay, thanks, Joyce. Sue?
Thanks, Rich. This is another one of those really challenging topics. We've certainly gotten a lot of feedback on this over the years, and every time we make an improvement to GAP that includes the words common control, we get an ask about trying to tell us what that means and how to apply it. But really what I thought was interesting, what resonated with me particularly, was when I read the memo and you have on a sheet of paper all of the areas within GAP where the common control is used, and it's sort of like, wow. And it's sort of just, brings it home on how important a project like this could be. And so I am supportive of doing a project. I'm skeptically optimistic that we can achieve success. I think it's going to be hard. I really do believe it's going to be hard. And I think, I think there were a number of suggestions from the comment letter respondents that were helpful. I like the idea of, starting with the SEC definition in EITF 025. I realize that it needs to be modernized. It kind of falls short, just some, but I also think that it's a good starting point. And I also like the suggestion on using, for the control aspect of common control, to use the 810 controlling financial interest definition. I do think, there's always a cost to the system whenever we change something. So I think we're going to have to be pretty diligent about making sure, sort of analyzing each of the areas in the codification where we use, a revised definition and how it will impact it. And I wonder if, much like you had said on the previous aspect of the consolidation project, if there's something within transition that we can look at to kind of maybe ease the burden of looking at very past transactions. But anyway, I'm supportive, and I think I agree with your objective and scope. And I think if we are successful, we really, much like Fred, this will be a huge improvement to the codification. I think it'll certainly make it more cohesive.
Great. So, Christine?
So I agree with my fellow board members. I think this project will be quite challenging. I think it will be quite costly as well. And I do think that it would improve the codification to have a definition within the codification. That said, my interpretation of the feedback that we got was really the problem is not with not having a definition. They look to, what is in GAAP, they look to what's outside GAAP, and generally can apply both the authoritative and non-authoritative guidance to get to a definition that seems to be relatively consistently applied. It seems that the problem is taking that definition and then applying it when there are really complex relationships and maybe limitations in the access to information. That project's not going to do anything about difficult places, difficulties in applying the common control definition when there are really complex relationships. And I don't think it could, because that's facts and circumstances specific. So it comes down to, is it a good use of standard setting resources to take on a really costly, challenging project to codify existing practice, which is, I think, what the objective of this ultimately would be, because we don't want to change outcomes. I actually don't think it is, so I wouldn't add this project for that reason.
Thanks, Christine. Hillary?
I appreciate the feedback from our stakeholders on this issue, and certainly this is an issue that we have heard over and over again as we've addressed different topics that have touched the common control guidance, or we've implemented guidance that relates to common control transactions. I'll agree with Sue that the 21 topics in the codification that refer to common control surprised me. Certainly, I knew it was pervasive. I maybe didn't identify it was quite that pervasive. I think this is an issue, comes up every time we do standard setting related to it. I think it's time to have a definition of common control. I actually don't think it's that hard to come up with a definition of common control using the non-authoritative guidance and guidance from the EITF 025 in the past. I think that provides us a great starting point to really be able to use that as a basis for common control definition. I think where some of the complexity comes in is that in the past, we have used the term common control differently in those different 21 topics, right? In certain times, we were intending people to consistently kind of, say, hey, go look at EITF 025 or the SEC non-authoritative guidance, right? We were comfortable with those outcomes. In other situations, we weren't comfortable with those outcomes. We maybe wanted the term common control to be broader. For example, looking at some of the private company exceptions, right? And I think that's absolutely fair to say that for maybe exceptions that we were hoping to be able to simplify guidance or make it easier for private companies to apply, we want more of those transactions to be in the scope versus in other situations where it may be requiring, historical cost basis, for example, maybe we are looking for a slightly more narrow definition from that standpoint. So while I think it is a a goal to say, let's come up with a definition of common control. I'm not sure I believe there is a single definition of common control. There might be a definition of common control, but we have things that we may add to that for purposes of private company exceptions or other areas where we think that that base level definition may need to be slightly adjusted to meet the needs from a standard setting perspective. I think that that's still a great project. I think if we can address a significant number of issues by being explicit with regards to what we believe are transactions under common control, and then being able to have thoughtful discussions with regards to when there may be a departure from that for certain reasons from a standard setting perspective, I'm perfectly comfortable with that. And I think that that would be a great outcome with regards to this project. Certainly, I think that not to say that that won't be challenging. I do think we're going to have to go through each of the different topics and determine how it was used and determine what we think unintended outcomes may be. But I do think that if we continue to say it's going to be very difficult to come up with a single definition of common control that can be applied in every circumstance, I think that level of kind of perfection is really hampering progress, right? And I think stakeholders have time and time again indicated you continue to, promulgate standards for common control transactions, but you haven't defined what common control is. I think that's a fair ask. So I'd be happy to add a project.
Thanks, Hillary. Always challenging going last, but maybe to echo some of my fellow board members' comments. So we have a term, common control, appears apparently 21 times in our codification. We've never defined it, but if you go to somebody who's really smart outside of GAAP, they'll tell you a definition each time it occurs. And maybe it's the same definition and maybe it's not. I actually agree with Hillary. I don't think it is. So I'm certainly supportive of adding a project. And I think the word common control should be defined. But I don't think we're going to use it in all of those 21 instances. I think we're going to use other terms. And I think that's a very important outcome of this project. We should always be concerned when if we define a term once or if we use a term once and there's enough context around it or there's an SEC staff speech, people are going to assume that applies every time the term is used. And I don't think that's the case here. So I do think, one, we should take control of it, define what common control is. We should go through these 21 scenarios. We're going to decide that some of them, that defined term doesn't work. We should pick another term so that we reduce any confusion or complexity around this. I also think the concept of, which will come with this control group, is another one. I've had numerous instances where we've dealt with very sophisticated preparers who had to be explained. We had to explain to them what a control group was and how they had to consider that as a common control type transaction. I don't think that's a frequent enough transaction that as we're going through this definition, I think we really should consider it and whether or not we can clarify that as part of this definition of common control. So with that, let me turn it back to Chris. So we did add a project to our agenda related to the definition of common control and its application in the 21 places so far that we've identified that it occurs. Okay. Chris, back to you.
Thanks, Rich. The invitation to comment on agenda consultation highlighted feedback on the interaction of the VIE guidance and the accounting for sale and leaseback transactions. The ITC noted that evaluating the VIE guidance can be complex for transactions that involve transfers of real estate to a legal entity subject to a repurchase option and a sale and leaseback of assets, particularly in private company transactions where the seller lessee may have limited access to information. Some stakeholders suggested revising or clarifying the sequencing of the examples in the VIE and lease guidance on sale and leaseback transactions. So said differently, we understood some to be highlighting that it can be difficult to determine whether a seller lessee should first apply the consolidation guidance in topic 810 or the lease guidance in topic 842 when evaluating a buyer lessor for consolidation. We also understand that in practice, the lease's classification can affect the consolidation analysis. For example, some practitioners have published views indicating that a lease's classification can affect whether a lessee has a variable interest in a lessor. 7 comment letter respondents addressed the interaction of the VIE guidance and the accounting for sale and leaseback transactions. 4 of those comment letter respondents, all practitioners, expressed support for addressing this issue. One stakeholder suggested that the board consider making minor amendments to clarify that in a sale and leaseback transaction, an analysis of whether consolidation of a legal entity is required should be performed under Topic 810 before the guidance in Topic 842 on leases is considered. Stakeholders, including practitioners and preparers that did not support a project, said that they are not aware of significant issues requiring changes to the current guidance. The staff considered the agenda decision criteria. We noted that relatively little feedback was received on this issue, and therefore we think more research would be needed to establish whether it's a pervasive issue. We're also unsure of whether providing guidance stating that the Topic 810 analysis has to be performed before considering the guidance in Topic 842 would address all of the issues that were identified in the ITC. For example, we're unsure if that approach would address private company transactions in which the seller lessee may have limited access to information about the buyer lessor. We also considered approaches that would have more significantly changed how leases are analyzed under Topic 810, but we were concerned that the scope of those changes wasn't justified by the feedback that we've received on this issue to date. Finally, we noted that Topic 810 more generally has somewhat limited guidance on leases, including finance leases. Therefore, we had some concerns that there would be pressure to expand the scope of this issue to eventually consider other transactions as well. For those reasons, we think additional research would need to be performed to understand if a project on this topic could meet the agenda decision criteria, and we do not recommend adding a project to the technical agenda at this time. With that, I'll turn it over to the board to discuss questions 7 and 8.
Any questions for the staff? All right. So
thanks for that analysis. I think based on how you outline the issue and sort of the feedback that we got from stakeholders, for me, it doesn't really meet the barometer of adding it to the agenda. I don't think that it was demonstrated, at least from the research that you did. I didn't realize you'd have to do more, that it was pervasive. And so I wouldn't be supportive of adding it at this time.
Thanks, Rich. So I agree with the staff recommendation. As you've pointed out, Chris, I agree that it has not met the agenda criteria. You've noted very important aspects such as the lack of pervasiveness and the potential that the guidance may not necessarily be improved and scoping is unclear. So I, at this time, would not support adding it.
okay, Marcia.
I agree with the staff, Sue and Joyce, and I would not add this project at this time. Thank you.
I also support the staff, I think, and thanks for a good job kind of overview of why this probably doesn't make sense at this point in time.
Christine.
I also agree with staff recommendation.
Hillary.
I agree with the staff recommendation. I certainly understand the question that's been raised, but I don't believe it meets the criteria to add to our agenda at this point.
Okay, and I'll make it unanimous. I agree with the staff recommendation. So just for sake of clarity, we're not adding a project to our agenda related to VIE consolidation and sale leaseback accounting interaction. Chris, your final consolidation issue?
Final for now. Thanks, Rich. The invitation to comment on agenda consultation also highlighted feedback on the interaction of the consolidation guidance and the guidance for the derecognition of non-financial assets in subtopic 61020. Specifically, this issue covered the accounting for distinct non-financial assets such as real estate when an entity ceases to hold a controlling financial interest in a legal entity that has each of the following characteristics. It does not meet the definition of a business. Substantially all of the fair value of its assets is concentrated in non-financial assets, and a reporting entity retains an option to reacquire the non-financial assets. Stakeholders noted that there is diversity in practice in accounting for the non-financial assets that the reporting entity is unable to derecognize under subtopic 61020, even though the underlying legal entity has been deconsolidated under topic 810. Those stakeholders suggested that the board consider providing guidance to address the accounting for the non-financial assets in the specific fact pattern. 5 comment letter respondents to the ITC, all practitioners, indicated that further work in this area should be prioritized, while 4 respondents, which were a mixture of stakeholders, indicated that this area should not be a high priority. Those that supported prioritizing this area stated that there's an increasing frequency of transactions affected by the intersection of topic 810 and subtopic 61020, and there is a lack of alignment between topic 810 and the derecognition guidance for subsidiaries that do not constitute a business. Those stakeholders noted that this can result in financial reporting outcomes that are not consistent with the underlying economics of the transaction. One practitioner that supported work in this area highlighted that if a reporting entity loses a controlling financial interest over a subsidiary under topic 810, but does not meet the relevant criteria for derecognition under subtopic 61020 or other applicable GAAP, it is not clear how the reporting entity should recharacterize the non-controlling interest in the previously controlled subsidiary. By contrast, those that did not support prioritizing this area stated that they are not aware of diversity in practice because the current guidance is sufficient, and the scenario contemplated by this issue is uncommon. The staff considered the agenda decision criteria for this issue as well. Similar to the previous issue, we think more research would be needed to establish whether this issue is pervasive, especially as some stakeholders asserted in comment letters that this issue is not common. To determine whether there are technically feasible solutions, the staff considered potential paths to addressing this guidance, including clarifying the guidance for the measurement and recognition of, for example, a financial liability under subtopic 61020, or revising the guidance to narrow the breadth of repurchase options that result in an entity being unable to derecognize a non-financial asset. However, the staff was concerned that these approaches would require similar amendments to be made to topic 606, or that the feedback received on this narrow issue might not justify a broad change. Because the guidance in subtopic 61020 is based on the guidance in topic 606 in many respects, we also think additional research would be needed to determine if this issue could have an identifiable scope, or whether changes in this area would also have implications for that topic 606 guidance. For those reasons, we think additional research would need to be performed to understand if a project on this issue could meet the agenda decision criteria, and we do not recommend adding a project to the technical agenda at this time. With that, I'll turn it over to the board to discuss questions 9 and 10.
Okay, any questions for the staff? Marcia?
So I agree with the staff analysis that at this time it's not clear this is, at this time it clearly does not meet our agenda criteria. I also would not add this to our agenda research at this point. I don't think the case has been persuasively made that it's necessary to continue to pursue.
Okay, thanks, Marcia. Fred?
Thanks. I also support the staff recommendation.
Joyce?
I support the staff recommendation.
Sue?
I also support the staff recommendation. I don't think that there's been demonstrated that it's pervasive. And I also don't think that in the scheme of all of the consolidation issues that we're looking at, that it would necessarily rise to the level of being a priority.
Okay, Christine?
I agree with staff.
Hillary?
I agree with the staff recommendation. And I think some of the concerns related to this issue, I do think that the guidance is sufficient. I think there's concerns people don't agree with that guidance, right? And I don't believe that there's a pervasive need to change at this point.
So I agree with the staff recommendation, but principally because I agree with the staff comments. I think this is failed sale accounting, and people don't like failed sale accounting. And to tackle this issue, I do agree we'd probably have to tackle the 606 revenue recognition failed sale accounting. Now, I would note we are dealing with this issue in our transfer of digital assets. And I think we've identified enough pervasive transactions there that we're dealing with it. Maybe at some point in time, the board's going to have to go back and consider, do we really need to revisit failed sale accounting? But I would say doing that more broadly would make sense in this case. So I also agree with the staff recommendation. So with that, that wraps up our consolidation issues for this morning. Thank you, team. And we're going to swap out our teams. Why don't we take, I have 10:08 on my clock. Why don't we take a break till 10:15 and then we'll reconvene on asset retirement obligations and environmental obligations.